Today, the Fed's mega pivot. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the Federal Reserve has flagged one of the most hawkish policy pivots in years, saying it will double the pace at which it's scaling back purchases of Treasuries and mortgage-backed securities to $30 billion a month, putting it on track to conclude the programme in early 2022 rather than mid-year as initially planned. Economic developments and changes in the outlook warrant this evolution of monetary policy, Federal Chair Jerome Powell told reporters during a post-meeting press conference. The economy has been making rapid progress toward maximum employment. This marks the next turn as they intensify their battle against the hottest inflation in the generation. And not only will they end their asset buying program earlier, but they are now also signalling interest rate rises in 2022 at a faster pace than expected. It seems the run of ultra-easy policy since the beginning of the COVID pandemic is coming to a close. Actually, easy monetary policy since the global financial crisis a decade ago. The Fed will be buying $60 billion of bonds each month starting in January, half the level prior to the November taper, and $30 billion less than it had been buying in December. The Fed was tapering by $15 billion a month in November, doubled that in December, and then will accelerate the reduction further in 2022. From there, the Fed at any time could start reducing its balance sheet either by selling securities outright or, in the more likely scenario, begin allowing the proceeds of its current bond holdings to run off each month at a controlled pace. The projections released on Wednesday shows that Fed officials see as many as 3 rate hikes coming in 2022, with 2 in the following year and 2 more in 2024. The dot plot of individual members' rate expectations show that just 6 of the 18 FOMC members saw fewer than 3 increases next year, and no members saw rates staying where they are now, anchored at near zero. The Fed has said it would likely not hike rates and continue buying bonds simultaneously, as the 2 moves would work at cross purposes. Economic developments and changes in the outlook warrants this evolution of monetary policy, which will continue to provide appropriate support for the economy, Chairman Jerome Powell said in his post-meeting news conference. The Federal Open Market Committee moves, approved unanimously, represents a substantial adjustment in policy that has been the loosest in its 108-year history. The post-meeting statement noted the impact from inflation, supply and demand imbalances related to the pandemic, and the reopening of the economy have continued to contribute to elevated levels of inflation, the statement said. The committee sharply ratcheted up its inflation outlook for 2021, pushing it to 5.3% from 4.2% for all items, and to 4.4% from 3.7% excluding food and energy. For 2022, the expectation is now 2.6% for headline inflation and 2.7% for core. They are both up from September. At the same time, the unemployment rate projection for 2021 comes down to 4.3% from 4.8% back in September. The statement noted that job gains have been solid in recent months and the unemployment rate has declined substantially. The statement reaffirmed that the Fed's benchmark overnight borrowing rate will stay near zero until labour market conditions have reached levels consistent with the committee's assessment of maximum employment. The committee reduced its forecast for economic growth this year, seeing GDP rising 5.5% for 2021, compared with 5.9% that was indicated in September. And officials revised their forecast in subsequent years, raising 2022 growth to 4% from 3.8% and lowering 2023 growth to 2.2% from 2.5%. The statement again noted that developments with the COVID pandemic, in particular with variants, pose risks to the outlook. Both policy moves came in response to escalating inflation, which is running at the highest level in 39 years for consumer prices, and wholesale prices in November jumped 9.6%, the fastest on record, in a sign that inflation pressures are becoming more ingrained and broad-based. Federal officials had, of course, long stressed that inflation was transitory, which Powell had defined as unlikely to leave a lasting imprint on the economy. He and other central bankers, as well as Treasury Secretary Janet Yellen, have stressed that prices are booming due to pandemic-related factors such as extraordinary demand that has outstripped supply but ultimately will fade. However, the term had become a pejorative, and the post-meeting statement eliminated it. Powell telegraphed the move during congressional testimony last month, saying it's probably a good time to retire that word and try to explain more clearly what we mean. For the Powell Fed, tightening policy now marks a dramatic pivot off a policy enacted just over a year ago known as flexible average inflation targeting, which means it would be content with inflation a little above or below its long-held 2% target. The policy's practical application was that the Fed was willing to let inflation run a little hot in the interests of completely healing the labour market from the hit it took during the pandemic. The Fed's new policy sought employment that was both full and inclusive across racial, gender and economic lines. Officials agreed not to raise interest rates in anticipation of increasing inflation, as the central bank had done in the past. However, as the transitory narrative came into question and inflation began to look stronger and more durable, the Fed has had to rethink its intentions and shift gears. The asset purchase taper began in November with a reduction of $10 billion in Treasury purchases and $5 billion in mortgage-backed securities. That still left the month's buys at $70 billion and $35 billion respectively. However, the Fed's $8.7 trillion balance sheet increased by just $2 billion over the past 4 weeks, with Treasury holdings up $52 billion and mortgage-backed securities actually reduced by $23 billion. Over the past 12 months, Treasury holdings have expanded by $978 billion, while mortgage-backed securities have risen by $567 billion. The quicker pullback puts Powell in position to raise rates earlier than previously anticipated to counter price pressures if necessary, even as the pandemic poses an ongoing challenge to the economic recovery. The Fed flagged concerns over the new Omicron strain, saying that risks to the economic outlook remain, including from the new variants of the virus. Powell said that policymakers eventually expect a gradual rate of policy firming. They don't anticipate raising rates before ending the taper process, but could hike before reaching full employment, he added. Economic activity is on track to expand at a robust pace this year, Powell said, adding that the economy has been making rapid progress toward maximum employment. The yield on the 10-year Treasury rose while the yield curve flattened sharply. Meanwhile, the S&P 500 index advanced and the dollar pushed higher. Traders lifted the amount of Fed interest rate increases they see for 2022 up to about 73 basis points. You are seeing a bit more panic instead of patience within the ranks of the FOMC, said Diane Swonk, chief economist at Grant Thornton. This is the first time we've seen the Federal Reserve chasing inflation in decades. On rates, with inflation having exceeded 2% for a time, the committee expects it will be appropriate to maintain this target range until labour market conditions have reached levels consistent with the committee's assessments of maximum employment. And of course, the FOMC vote was unanimous. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation, the FOMC said. While the accelerated taper was in line with expectations from the majority of economists surveyed by Bloomberg, the interest rate path was steeper than that which analysts had generally seen. Investors had been expecting a rate hike by mid-year, according to trading in futures contracts, with some chance of a move as soon as March. Powell, whom President Joe Biden recently renominated for a second 4-year term at the helm of the central bank, has faced increasing pressure from both Democrats and Republicans to take more aggressive action on inflation. Fed officials were caught off guard by the price pressures, which they argued would fade as the world adjusted to COVID-19. Instead, the pandemic has continued and inflation has soared, fanned by supply chain bottlenecks and strong demand amid massive fiscal and monetary policy support. The S&P 500 cut early losses to close sharply higher on Wednesday, underpinned by a rebound in tech stocks after the Federal Reserve said that it would accelerate its taper and projected the first lift-off in rates next year. The S&P 500 was up 1.63% to 4,709. The Dow Jones Industrial Average was up 1.1% and the Nasdaq was up 2.1%. We see our forecast of 3 interest rate hikes in 2022, the first probably in the spring, second quarter, confirmed, Commerzbank said in the note. Risk sentiment improved following the announcement, as a faster taper and earlier path to monetary policy tightening was largely priced in already ahead of that Fed meeting. Google parent Alphabet, Microsoft, Facebook and Apple, which combined makes up more than 1/5 of the broader S&P 500, cut their losses and sparked a broader market rebound. Energy remained under pressure though, even as oil prices cut their losses. They were up 1.5%, as fears persisted about supply outpacing demand in the wake of growing concerns about the Omicron threat to travel and ultimately energy demand. The VIX or fear index was lower, down 11.88%. Gold was slightly higher, but still within the band below $1,800, and the dollar index was down 0.24%. Now, of course, the big question is this. With the interest rates now set to rise, and with the tapering coming off, will the markets hold their faith that assets are still fair value, or will they start to question that? And with the removal of all the stimulus and support, are we likely to ultimately move into a deflationary phase rather than an inflationary phase? Because the Fed is still arguing that inflation is probably somewhat temporary, even if they don't want to use that word now. So this does mark a change, a significant change. But if you look at it carefully, there are still significant deflationary measures in the economy. And I would highlight the fact that some of the more recent economic data is still disappointing on the downside. And of course, Omicron is still there in the background. So we're not out of the woods yet. And just as one illustration of the issues ahead, because what happens over there, of course, has an impact over here, particularly with regard to interest rates, it's interesting that CBA has hiked its interest rates yet again, making its 4th such fixed rate rise in just 2 months. The standout rise was in the long-term rates, with the 4-year fixed going up by 25 points from 3.09% to 3.34%, and 5-year fix went from 3.39% to 3.59%. That's a 20 basis point rise. For shorter term rates, the rise was not as steep. The 1-year rate went up by 0.05 points to 2.54%. 2-year went up 10 points to 2.69%, and 3-year rose 15 points to 3.14%. The move widened the gap between the 2-year and the 3-year to 45 basis points, signalling yet further that CBA thinks that the cash rate will rise in 2023. The rate of change in the market has been rapid in recent weeks, with 4 rises apiece across all of the Big Four, in line with the Reserve Bank of Australia changing its cash rate rise schedule and abandoning the date of 2024 to move the basic costs of funds. CBA has now added more than a whole percentage point to their 4-year rate since the middle of October, with close to a full point in 3-year fixed as well. So here you see the fallout. Interest rates are on the rise. That's going to dampen activity, dampen momentum in the property sector and beyond. And that is why I say that there is still significant deflationary risk in the narrative. Mind you, it's not one that many people want to recognise yet, but we'll see whether it develops ahead. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.